Hey guys, this is Dawson's Discussions, and this is Nathan L. Dawson Jr. This is actually a video, well, part two of one of my videos that is of savings and investing. The first part was savings and retirement, but this one is actually going to is going to be based on investing because investing that is a very big subject itself aside from retirement. So investing is pretty much for everybody. Primary reason why I advocate investing is because it's actually a very good tactic in order to create personal wealth for yourself and generational wealth for your lineage, like your great grandchild or your infinity times great grandchild, so on and so forth like that. One of the things that I really like to make a hobby is investing, learning about it, talking about it, and so on and so forth. So here we go, investing. Well, these days, investing in the financial markets has never been friendlier to small investors. At least if you invest in equities and bonds and on the financial markets like stock exchanges and the bond market and so on and so forth like that. Um, what you want to do before you invest is, of course, set up your budget, follow the budget, kind of cut spending on where you want to cut, and then take the remaining money and then put some into an emergency fund, build up your emergency fund, and your go getter fund, like for your go getter, down payment for a new car, vacation, so on and so forth with that. Also, probably explore the possibility of hiring a professional, like a certified financial planner, and then you can actually go on and then go on and then start investing like that. So, investing is essentially the allocation of money and the expectation of benefit in the future. In finance, the benefit from an investment is called a return. The return may consist of a gain or loss realized from the sale of property or an investment, unrealized capital appreciation or depreciation, or investment income such as dividends, interest, rental income, etc., or the combination of capital gains and income. So, investing is generally for the long term. At least 5 years is usually the goal on how long you want to stay investing for. So, um, taxes and inflation are usually things that you want to keep in mind for um, investing, because you can actually get taxed on your capital gains, and there's also like certain investments that if you know really what you're doing, you can actually be paying I think zero taxes on certain investments. um, I think Robert T. Kiyosaki, I think he said that he didn't really pay a whole lot of taxes for, I think, real estate. 'Cause I think real estate, which I'm going to talk about in another video, is how real estate investing can actually help your create like a lower tax bill for you. But one of the things that you really want to do for investing is compounding. Compound interest is the addition of interest to the principal sum of a loan or deposit, or in other words, interest on top of interest. It is a result of reinvesting interest then rather than paying it out, so that the interest of the next period is then earned on the principal sum plus previous accumulated interest, which is usually standard in finance and economics. So, one of the things that you want to do is to reinvest your dividends or reinvest your interest, because when you own a stock, you actually get paid a dividend depending on if it's like a dividend paying stock. But you don't want to take the dividend and then convert it to cash. What you want to do is take the dividend that you get paid from and then use that dividend to buy even more stocks and more shares, and then you can actually get a much larger dividend payout, and then instead of not converting it to cash, go right back into reinvest those dividends, and then keep going, so on and so forth, and then you can actually grow and then compound. Compound interest is much different from simple interest, where the interest is not added to the principal. The only way to overcome taxes and inflation is to really put the power of compound interest and the time to work in a long term, yet disciplined investment plan. If you do not earn interest equal to or at least the rate of inflation on your investment, then you're losing money every year. So again, what you want to do for your interest, not for your interest, for your investment is outpace inflation, lower your tax bill, create enough wealth for yourself, and to create generational wealth um, for your lineage. Those are actually the four main goals: outpace inflation, lower your tax bill, and create personal wealth for yourself, and create personal generational wealth for your lineage. Okay, so the investment vehicles, so like what can you use to do such a thing, like for those four things. So let's talk about stocks. Uh, a stock represents a share in an ownership of a company, including a claim on the company's earnings and assets. You can buy stocks in the U.S. companies, foreign companies, large companies, small companies, companies that analysts think that will grow, and companies that analysts think are currently selling at a bargain. As such, stockholders are partial owners of the company. When the value of the business rises or falls, so does the value of the stock. Investors buy and sell stocks for several reasons, including the potential to grow the value of the investment over time, just like how I alluded to, just like how I mentioned earlier, to potentially profit for short-term stock price moves, the fluctuation, how I said earlier, is what for capital gains, or to even earn an income by investing in dividend-paying stocks. Keep in mind that the price of a stock can fall just as easily it can rise up, which is called the volatility. Investing in a stock offers no guarantee that you will make money, and many investors actually lose money instead. Stocks are an important part of any portfolio because of their potential for growth and higher income versus other investment products like bonds, which I'm going to cover next. So you get money from stocks from dividends that they pay out every month or maybe quarterly, depending on the schedule that the company or corporation pays it, and capital gains. Capital gains, just like how I alluded to earlier, you buy a stock at $10 and you sell the stock for $10 is the capital gains. Dividends, they just keep giving you money just for holding the stock. The return rate is usually 10 to 12%. It's high risk, but best choice for growth. And that's stocks. A bond is a debt security or a loan to a company or government that pays investors a fixed rate of return over a specific time frame. Unlike stocks, which are purchased shares of a company and a company, shares of ownership in a company, bonds are the purchase of a company or a public entity's debt obligation to you. Considered a safer investment than stocks, bonds generally earn a lower return on investment. For example, long-term government bonds historically earn around 5% in annual returns. The relatively safety of bonds help balance the risk associated with stock-based investments that can provide a fixed source of income. Companies and governments issue bonds to fund their day-to-day expenses or their day-to-day operations or finance specific projects. When you buy a bond, you're essentially loaning your money for a certain period of time to the issuer, whether it be General Electric or Facebook, Google, Tesla, or even the federal government through treasury bonds or savings bond. So essentially, a bond represents a loan, provides fixed income payments. It's a reliable source of income. The return rate is usually 3.7% to 6%. Moderate level of liquidity and typically purchased through a broker like Fidelity, TD Ameritrade, E-Trade, Vanguard, Charles Schwab, the much larger ones, and then of course you have the smaller ones like M1 Finance, like M1 Finance and more and more. Now, a mutual fund. A mutual fund is a investment vehicle comprised of a pool of funds from many investors that buy stocks, bonds, and other uh, tradable assets. When you purchase a mutual fund, you get exposure to all investments in that fund, which is called diversification. Mutual funds make it easy to build a diversified portfolio, and you can also get a professional manager, so you don't have to research, buy, track every security in that fund. Now, there are a variety of fees that may be associated with mutual funds. Some funds come with transaction charges for buys and sales or commissions, known as loads. There are funds that charge a redemption fee if you sell shares you've only owned for a very short time. Investors also pay ongoing expenses to cover the cost of operating the fund. This includes investment advisory fees, paying the fund manager and the research staff, as well as transaction costs associated with buying and selling securities within the fund. When evaluating a fund, remember that fees play a factor and may potentially detract from a fund's performance over time. So mutual funds, at least the active managed mutual funds, because they're actually where you have a guy and then he pools money together and then he or she, don't want to be accused of sexist, but I'm just using he for a broad term. He would actually manage the fund, and then if you do good, then you get a good return. But if you do bad, you lose money. Plus, you also have to pay him a research fee and a management fee. So that's why many people really don't like mutual funds, because 9 times out of 10, mutual fund managers, they don't really beat the market. They don't really get a whole lot of returns. So only 1 out of 10 they actually really do know. I wouldn't say not not knowing what they are doing, but they probably think that they do. But then again, that they not necessarily not know what they're doing, but because the market, it fluctuates. Like one moment it can go down, and then next minute it goes right back up, and then when it goes up, next minute it goes right back down. So it's kind of hard to time it, but an actively managed mutual fund is trying to beat the market. So, and then that actually led towards the index fund, and then you have the exchange traded fund. The exchange traded fund, or ETF, is literally what the name implies. Exchange traded funds that trade on exchange, right? Yeah. That try to track a specific index. When you invest in an index fund, you get a bundle of assets like diversification that you can buy and sell during market hours, potentially lowering your risk exposure while helping diversify your portfolio. It's usually low cost, lower operating expense ratios. The flexibility, you can easily trade it. It's also very tax efficient, and generally, these things are usually used in robo-advisors. Robo-advisors are not necessarily robots, but investment software applications that help people invest who really don't want to be active in their own investments. Well-known robo-advisors would be Betterment, Wealthfront, Wealthfront, no, Wealthfront, THFRONT. Wealthfront, Wealth Simple, Sig Wealth Management is also another one. Um, and there's probably a few more robo advisors, but those are the well-known robo advisors that I know. Some may even call Acorns to be a robo advisor with their roundup feature. M1 Finance was kind of the hybrid between trading and algorithms, because really robo advisor, they have algorithms that actually do the work for you instead of having a human advisor. So for robo advisors, they use ETFs because it's more tax efficient and it's lower cost, which is why they're becoming more popular over time. Also, you have the index fund, which I said a few seconds ago. An index fund is a type of mutual fund with a portfolio constructed to match or track components of a financial market index. An index mutual fund is said to provide broad market exposure, low operating expenses, and low portfolio turnover. These funds follow their benchmark index, no matter the state of the market. Now, many know, of course, if you've been hearing like the finance side of news or news in general about finances and the economy, many know the index called the Standard & Poor's 500 index, or the S&P 500, which is the top largest 500 corporations on the U.S. stock exchange. You also have the National Association Securities Dealership Automated Quotations, or NASDAQ, NASDAQ Composite Index, which is a stock market index of the stocks listed on the NASDAQ stock market exchange, which mostly comprises of technological biotech companies. Then you also have the Dow Jones Industrial Average Index, or the DJIA, which is a stock market index that measures the top performance of 30 large companies listed on the stock exchange in the U.S. Although it's one of the most commonly known and most commonly followed equity indices, many consider the Dow not to be a good representation of the U.S. stock market. Then you have the Russell Stock Market Index, which is the well-known index of the series. Well, the most well-known index of the series is the Russell 2000, which tracks the U.S. small cap stocks, which is the bottom part of the 2000 stocks within the Russell index. So small cap are usually less than, I think, a million, in the net worth. And then you have like the medium cap, which is like maybe a million to 10 million. And then you have the large cap, which is like a billion. I don't have the exact number, but you know that, small, then medium, to large, because of the millions and billions, like the order of numbers, like millions is lowest and billions is the highest. And then mid is somewhere there. I don't know, like, off the top of my head, but you can kind of allude to like what I'm getting with. Like the U.S. small cap, like their net worth is smaller, and then of course that a large cap, they got to be in the billions, like that. Then you also have another index, which is the Wilshire 5000 Total Market Index, or just you could just call it the Wilshire 5000, where the market cap is the value of all U.S. stocks actively traded in the U.S. So as of December 31st, 2019, this index only comprised of 3,473 companies. So index funds are usually considered ideal core holdings for retirement accounts, such as IRAs and 401ks. Even through the federal government version of the retirement program, through the savings plan, or TSP. Again, TSP is only for U.S. federal government employees and the military. Like the index funds that the index funds I know is the C fund, which is the common stock, tries to mimic the S&P 500. You have the S fund, which is trying to copy the Dow Jones Industrial Average, like the large companies not involved in the S&P 500. Then you have the International I Fund, which tries to copy the Morgan Stanley uh, capital industrialization. Probably get the I part wrong. For the Europe, Australasia, Far East, which is all the developed countries outside the U.S. Like, it took me a while for me to know that Shell, even though it's in the United States, it's not a U.S. company. It's actually a Dutch company, like the Shell Gas, Samsung. That's an international company that we're all familiar with. I think it's part of IFA, EAFE. And then those are three stocks. Then you have uh, the G Fund, which is guaranteed by the government, which is the government securities, which is the lowest, which have the lowest return. And then you also have the F Fund, which is the bridge tries to mimic the Bloomberg's Barclays bond market index. So those are the funds within the TSP. Just for those who don't know about TSP, I'll just give you a little bit of background on it. So, legendary investor and Berkshire Hathaway chairman Warren Edward Buffett and John Jack Clifton Bogle of the Vanguard Group recommended index funds for having savings for your retirement, rather than picking and choosing individual stocks for investment. Makes much more sense for you just to buy all the companies in the S&P 500 because of the low cost. Just keep putting your money in there and let it compound and grow. Also, you have the Real Estate Investment Trust, or a REIT, REIT. Now, a Real Estate Investment Trust, or a REIT, is a company that owns, operates, and finances income-producing real estate. Essentially, it's like a stock, but for real estate. They usually generally have. Generally, anybody can invest in a REIT. They share the income produced by a real estate investment company without actually having to go out and buy or manage or finance a rental property. But a REIT must pay out at least 90% of the taxable income to shareholders, and most pay out 100%. In turn, shareholders pay income taxes on those dividends. And also, another investment tool is a commodity. A commodity are goods that are more or less uniform in the quality and utility of regulation of their source. So when shoppers, go buy like an ear of corn or wheat at the supermarket, we normally don't pay that much attention to where they were grown or milled. So, commodity goods are interchangeable, and by that definition, a whole host of products for which people really don't care about buying a certain brand could potentially qualify as a commodity. So just like a commodity, just it could be tangible or intangible, like a raw material. So the one commodities out there that people invest in is gold, silver, oil. Yeah, oil. Well, the joke about America, we are addicted to oil. We always go after oil. The whole mess in the Middle East, of course, oil. You can also invest in, I think, coal, even livestock. So you can actually invest directly into the commodity, or you can use the futures contracts, or buy ETF that specialize in commodities, or you can actually buy stock in companies that produce commodities. So you can actually invest in commodities, doing it like that. But to invest directly into it, it's very, very, very hard. You need a whole lot of money. Again, back to Robert T. Kiyosaki, he said that he really do, what he really do like to invest in is real estate and commodities because of the illiquidity, and you really have to study and have a whole lot of capital. He really don't like to invest in what he called paper, which is stocks, bonds, mutual funds, ETFs, so on and so forth, because of the liquidity. Because if anything goes wrong, you can hurry up and sell that, and you really don't need a whole lot of knowledge to get into it. I mean, you kind of do because you want to know, like, if you really want to be successful, you have to do your research, but you don't really do a whole lot of research. At least what he say is for real estate, because when you're in real estate, it's very hard to let it go illiquid. Yeah, it's very illiquid, which means you can't liquidate that asset into cash. Same thing with commodities. Cause I think he said he invests a whole lot in oil. And then you have trading options. Think of it as you bet on a horse at a racetrack. Each person bet against all other persons there. The track is simply takes a small cut of providing the facilities. So trading options is like better at the horse track, which is a zero sum game. They really don't know a whole lot about options. They also have futures, derivative financial contracts that obligate the parties to transact an asset at a predetermined future date and price. Don't really know a whole lot about futures. I think it's like a contract. Um, Allow traders to lock in a price of an underlying asset or a commodity. Um, yeah, I really don't know a whole lot about futures. I don't really deal with futures that much. They say you trade. I don't really. Me personally, my investment strategy is buying and holding. Like, I'll just buy it and then hold on to it. Because many they'll just buy and sell, but some just I'll just buy and hold. Many, like, like Jack Bogle and Warren Buffett said, it's very good idea for you just to buy and hold. So I don't really deal too a lot with trading. Nothing wrong with trading. It's just not for me because I don't have the time, experience to learn or to actually do trading. And you also have foreign currency exchange, which is Forex, the marketplace where various national currencies are traded. Trillions of dollars are changing hands every day. No centralized location. Then you have cryptocurrency, which is like Bitcoin, digital or virtual currency that is secured by cryptography, which makes it nearly impossible to counterfeit or double spend, which is a new form of digital asset. Cryptocurrencies usually face criticism because the exchange rate volatility and vulnerabilities of the infrastructure underlying them. They say the good thing about cryptocurrency holds the promise to make it easier to transfer funds directly between two parties. These transfers are instead secured by use of public keys and private keys. That's why there's no need for a bank or credit card company to be involved in all that. Disadvantages: semi-anonymous nature of cryptocurrency transactions makes them well suited for a host of illegal activities such as money laundering and tax evasion. But some cryptocurrency advocates often value their anonymity, citing benefits of privacy like protection for whistleblowers or activists living under repressive governments. Like you have like Bitcoin. Bitcoin is actually a example of cryptocurrency. I'm currently not invested in cryptocurrency yet because again, I don't really know a whole lot about cryptocurrency, and it doesn't really interest me because I'm actually taking my investments kind of slow. I mean, I have been investing in my TSP, which is the 401k for the federal government employees, but cryptocurrency. Of course, people probably might laugh at me saying like, "Oh, you should be on the cryptocurrency, on the cryptocurrency, fad." Well, some people say that it's not a fad; it's the future. But I'm just gonna, experiment with one asset first, then probably jump into cryptocurrency. later on. Like I might jump into, I might invest like maybe a penny, or because I did, yeah, because I'm a little skeptical about cryptocurrency, so I'm just gonna once I actually do know more about it, at least the time of filming this video, I'm actually gonna read about cryptocurrency. But then again, I'm not sure if cryptocurrency is for me or for my investing strategy because I'm actually more into buying and holding instead of me just trading, like that. So, and this concludes this video on the assets that you can actually invest in the financial markets. So this is Nathan Dawson from Dawson's Discussions, and I will see you in the next episode, which should be the last episode, at least for investing, not investing, but for building wealth. So the next one's going to be real estate, and then I'm going to close it with the history on our financial history in America. So this is also discussions.